And it's those that got their mortgages fraudulently last year that are getting absolutely murdered right now because the interest rates.
Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify. Konstantin, welcome back yet again. There's a lot of weird stuff happening in the market, and you're the guy I like to go to for the scoop. So what's happening? Because I have seen a lot of interesting news articles. In particular, the big five banks, some of them are getting sued, or fined, I should say, for giving out bad loans, being accused of money laundering, all kinds of weird stuff. So tell me, what's happening out there right now?
Well, I think the comment about I think what you're referring to is the FinTRAC fines that came out, I think, right? I think it was RBC who got fined, a few more other guys got fined.
So RBC got fined about FinTRAC.
$7 million, something like that, it was fined.
Correct. And no, it was billion. It was like 5.2 billion.
Billion? I can't remember. I briefly looked through the article.
And then CIBC got fined by office fee, I think, if I'm not mistaken.
CIBC has been under watch for some time.
And then TD as well also got in some trouble, I think.
I mean, none of it is really surprising, to be entirely honest with you. And I think the reason why it's not surprising to me is because we often treat large organizations as one, but they're never just one person. They're not one entity. You know, like same as a government, a large organization like TD, RBC, or CIBC can't fully control bad actors within the organization. And so there would be probably more lawsuits, more fines if you started to go through every single book of business for every single bank, because the reality of it is that, there will always be bad actors in every industry, and banking is no different than any other industry in this regard. And all these fines, all this fraud that is being referred to, I don't think it's any one specific person. It's probably groups of individuals, who infiltrated organizations, who were successful in doing certain things for some period of time, all right, got away with certain things, and then eventually now they're being audited, now they're getting caught. And I'm sure that as banks are reviewing their books and they're noticing the trends in terms of who were the people behind the volumes of fraud as opposed to the volumes of good business, I'm sure that the bad actors will be punished, and we will have to learn from this experience, and the banks will have to learn from this experience to improve their processes. And that's just the natural course of how, I guess, every industry runs. You know, there will always be situations where things get a little loose, people are not checking things too thoroughly, and then this kind of a result will happen, and then they'll tighten it up, they'll improve their processes, and things will be done the correct way.
How do you think that's going to affect the market overall if there are a ton of bad loans out there, if the underwriting was not done up to snuff?
Yeah.
And if appraisals in particular were fugazis, how is that going to affect things? Are we going to see, that come home to roost? Are we going to start seeing properties being pulled onto the market because of that?
So we have had, as a country, we have had occasions in the last just even several years where there were other financial institutions, maybe that shall not be named in this specific podcast. You can research this. I'll just say 2017 is the year you want to look. But there were other financial institutions that also got in trouble for similar reasons, where things weren't checked through properly, or there was, some speculation that maybe the amount of fraud that really took place in their book of business is significantly worse than what is being disclosed, because there was some disclosures made to that extent. And like what happened in the past is we have essentially seen that when these types of situations happen, market reacts in weird ways, and I'll explain how. But loans, generally speaking, that were lent on these mortgages, I shouldn't say rarely, but in a lot of cases don't go sour until perhaps, there's enough tension that they do. But in most cases, people pay mortgages first. Like nobody is sitting there and picking, well, this month I'm going to pay my phone bill and then my utility bill, and maybe I'll pay like half my mortgage payment. Like everybody, when they look at their household budget, whether it is a mortgage or rent, comes first, right? And so by virtue of that alone, no matter how bad the situation you're in, no matter how fraudulent your loan was, you are going to make sure that you maintain your mortgage first and foremost. You're going to default on everything else. I mean, and I've seen this 1,000 times. When I'll get a file, for a mortgage application where they're trying to do a refinance, and when I look at the original loan, it's hard for me to ignore the fact that I just can't understand how could they have possibly qualified for it in the first place, right? And so what you do in those cases is you sort of roll with the punches. The last few years, for a lot of people who may have gotten their loans fraudulently, probably were somewhat nice because they got their properties appreciating to a level that I've never seen before. And it's those that got their mortgages fraudulently last year that are getting absolutely murdered right now because the interest rates, they were variable if they were picking variable rate over fixed, are squeezing them real tight right now. And even if they thought that they could qualify for these payments and they could maintain them, they really can't anymore because budget just doesn't make sense. There's no room in their budget for any more payments. And so with those types of borrowers, and this is what we're seeing now with, I think, the resurgence of power of sale in the market, is that those borrowers will suffer to a degree that is different than, let's say, the ones that got to benefit from the appreciation in real estate in the last 3 to 4 to 5 years. And those purchases from last year that people can't bear, right? They will probably be looking at ways of liquidating. And the main challenge for those people right now is that liquidating in 2023, especially at the end of the year right now, is very difficult because of lack of activity. There's not a lot of buyers. And values that people are looking to pay for your properties just aren't the same, right? So like another trend that's become quite common, and this is what I've been getting a lot of applications with, we'll get a mortgage application for a second or a first to refinance existing debt, but there's no equity. It's not just that there's no equity, it's negative equity in this property. Like there's more debt. There's significantly more debt that these people carry against these properties than there is any equity whatsoever. And good examples of these types of scenarios would be places like Hamilton, right? Hamilton had quite a fair amount of appreciation in the prior years, and then like last year it started to deteriorate, and this year it's just been like very silent in a lot of cases. Like there's not a lot of sales in Hamilton, and so properties that were worth 650 or 660 in the peak are not even selling for 5. And they have to go to an even greater discount. And those are the ones that we're going to see probably really become tricky because the lenders that lent on those properties, they're sitting there saying, pay me what I lent you, and the customer is saying, I can't even sell the property for as much as I bought it for, and I definitely can't pay you back what I owe you. Like those are going to be tricky situations, and in a lot of cases, customers will take until the very, very last minute to do something, and probably those properties will go into power of sales. And the power of sales, as we know, they're fire sales. The lender is trying to dispose of the property in the fastest possible period of time so they don't bleed any more money, don't bleed any more fees or any more costs. And for that reason, those are going to be probably a lot more common for the people that bought last year and are suffering, especially the ones that bought properties with some fraudulent applications as far as the mortgages go, because they just simply don't have it in their reserves to maintain them, right? So you're right, there's probably going to be quite a number of sales coming up in the spring market, right? We don't know exactly how many. It seems to be like we're starting to hit that period where the rates have been going up for long enough that there's been enough tension for enough period of time that now people are really starting to drop properties, and there's a lot more inventory that we've seen like in quite a long time. So that's kind of, I guess, my summary of that. I'm not sure if that fully answers the question.
It does. I've been hearing conflicting things though, because we know now, and you were actually the first person who on this podcast was really kind of screaming bloody murder about the kind of 12 to 18 month lag on interest rate increases and the result of that. We know that household savings skyrocketed during COVID with all the, just money floating around and insane amounts of money printing that was happening. All of that liquidity has now been withdrawn from the market. Household savings are basically back to, pre-COVID states, if not lower. Near zero, really. And that's why we saw people still, kind of out at restaurants and things like that during that first round of interest rate hikes when we were in 2022, and there seemed to be no recession at that time, and now it seems like there's a lot more pain that people are feeling in the market. I did, however, hear a bit of a light at the end of the tunnel. 2 weeks ago or last week, I think it was. I think it was last week. So last week I was at a real estate conference with Richard Robbins. He's just a big real estate guru guy, and big fan of his, by the way. Richard, if you're watching this, shout out. He's a great dude. And he brought in a few amazing speakers, one of whom was Benjamin Tal. And so listening to Benjamin Tal in person, he's the chief economist for CIBC, absolutely brilliant guy who also has a really good sense of humor, which is extremely rare for economists. So it was very interesting to actually listen to him. And one of the things that he pointed out is that, he meets with the Bank of Canada all the time, and he's been really stressing to them that he feels that they've over-tightened and that they've delayed the reaction in tightening for too long, and then when they did tighten, they overreacted. He is now really confidently saying, and I mean, take this with a grain of salt, right? Economists are taking their best educated guess, just like any doctor would, I guess, that we are going to see rates start to actually lower in Q2 of 2024, possibly Q3, but he was saying definitely we're going to see that start to ease up then. What are your thoughts on that?
Yeah, well, it's very, it would be wrong for me to ignore that comment because Mr. Tal is a very smart man, and he's been watching the Canadian economy for probably double to triple to quadruple of how long I've been doing this for. And so, the argument that the Bank of Canada may have overshot with their rate hikes, probably true, because, I mean, look at the market and what it's doing right now, right? Like, you were hoping for some activity. I mean, there's like bare bones of any activity happening right now compared to what we had before. So, yes, they probably overshot a little bit, but we all expected it and we all wanted it. We asked for it, in a way, because we've been bashing the Bank of Canada for not doing enough. And it's like one of those, I think the best example, the best analogy I can think of for this, what we're doing is, imagine that we are the coaching, we're the coaching staff for a basketball team, and the basketball team consists of various players. One of those various players is Bank of Canada, and there's other ministers and ministries that are other players in this basketball team. And so, this player, named Bank of Canada, is walking onto court. Bank of Canada has only had so many balls they had a chance to throw in the last few years, because every time they throw a ball, what I mean by that is that they make a decision on the rate, right? They increase it or they decrease it or whatever. Doing nothing, let's just call it, is just being indecisive and not shooting at all. So it's like you only really have so many times they get to play with the ball and so many attempts to hit it right. And the fact that they, with lack of practice or the lack of ability to practice this well enough with a live economy, with a country in their hands to practice with, it's very easy to overshoot. It's very easy to overshoot, very easy to undershoot. So as much as we blame the Bank of Canada for a lot of things like not acting fast enough or maybe sometimes acting a little bit too aggressively, it is basically just because of the way that the cards are dealt to them and the way they have to make their decisions, because they don't get a lot of practice of what happens if you increase the rates by 50 basis points in this specific instance. What happens if you raise the interest rates by 100 basis points in this instance. So they're left with really the only option, and that is just trial and error, right? And so they've come through. They had plenty of time to trial. And okay, fine, there's maybe a little bit of an error with how much we've overshot with the interest rate hikes, and that's also okay. That's also okay. In fact, let's do that, and let's slow things down a little bit, and let's actually wait it out until we can do this comfortably, so that we know that we're doing the right thing by decreasing interest rates in 2024 slowly, right? So that we're not making decisions that will make things volatile. I think that's what we want to prevent. I think preventing volatility in how people react to the next change in the interest rate is what we want more than anything else. We want people to make educated decisions and strategically planning their real estate portfolios and their wealth, as opposed to jumping on things because the interest rate just got 150 basis points better, right? So I'd say like that's probably how I would look at it.
I guess the way that Benjamin Tal phrased it was very interesting when he was speaking, is that we had front loaded a lot of activity and basically taken sales activity from the future into the present moment a couple of years ago. And so front loading all of that activity, now that time has come where the piper needs to get paid. And that activity is, I mean, we've created a vacuum in this time space that we're in right now for that sales activity, and it can't go anywhere. And people are stuck between a rock and a hard place. Given the amount of immigration, though, that we've done over the last, let's call it 18 months, if rates do start to come down, we've basically spring-loaded a boom that would probably be more aggressive than anything we've ever actually seen before, which kind of scares me because I am looking at the stats. I'm kind of a nerd, as you know. On my YouTube channel, I try to be as data-driven as I can be. And in the comment section, it's always, kind of, if you're not spelling doom and gloom, you're kind of just, roasted. And I try to be even and balanced in my viewpoints as much as I can be, but when things look grim, they do look grim. However, right now, I'm finding that things are actually, in my view at least, not too grim. It feels like that sales activity is gone, but it's like almost like we're at a trough, I guess you could say. And the consumer confidence in real estate seems to actually somehow be picking up. And I wanted to know what you were seeing on your end in terms of that, because if consumer confidence turns around in Toronto, this isn't Hamilton. When the market turns here, there's no dimmer. It's a light switch. It's either everything's dead or everything's on fire.
I like that. It really is a light switch in Toronto. Yeah.
So what are you seeing on your end? Are you seeing consumer confidence starting to return? And what are your thoughts for 2024?
Yeah, consumer confidence has not returned. No, it has not returned. I mean, I have, I have in my CRM, I have a whole column that is just pre-approvals. I don't know how many I have. There's probably like 3 dozen of them. And this is just in the last like 6 months. And so those were all people who got pre-approved that went out, looked around, shopped, actually placed offers. Probably a few of them got, their offers accepted and it just didn't work out for whatever reason. Some of them didn't end up getting their offers accepted at all. But like that column is very deep, and like I'm good at pitching, mortgages. It's just that they, for some reason, decided to hold back and maybe not do something for right now. And that's a trend, right? So if especially first-time buyers are scared out of their mind in a lot of ways, they just don't know what's right anymore. They're like, is this the right time to buy? This is the bad time to buy. Should I just wait a little bit longer, right? Like this is the normal conversation with people that are not sure. But on the other side, you have like rich people going out, literally starting funds just to buy up the real estate. That is going to be, to them, sold at a discount, right? Because when you look at these types of situations, I think I heard you say this a little while back. It was like, why let a good disaster go to waste, or like why let a good catastrophe go to waste? And I was like, that's very, very clever. Like in this case, this is exactly what these people are doing. So, and that activity is not meant to be like paying top dollar activity. That's lowballing, getting whatever you can, get away with, so to speak, just so you can stack up your portfolio with properties you can probably renovate, like rent out, whatever you got to do. If you got cash, what do you care? All right. It's an asset that you're buying at a discount. You're buying at a discount now because you're looking into the future and you understand the dynamic of, there is, before every war, there is peace, right? And tension is precursor of relief. And if you think about that conceptually, like if this right now is the peak tension, that we are experiencing with the interest rates, and interest rates are the predictor of activity in real estate, well, where there is tension, eventually there is relief. And when the relief comes, the gates will open, and then everybody's going to say, oh, I wish I did something, 5 months ago when things were bad, but I wasn't sure, and how can I blame myself for not doing something back then? So, like, the end of 2024, I'm gladly going to share this. The end of 2024, the number one requests for financing are actually, specifically in Canada, we're talking about Canadian real estate and Canadian mortgages. But number one request, the month of November and December 2023, were actually private mortgages just to get money to pay back the CIBC loans, right? What an interesting activity, because the CIBC loans were the loans that the Canadian government gave out to businesses as an emergency assistance. And the CIBC loan ceiling was $60,000. And of the $60,000, if you repaid 40 back before the end of the year 2023, you were forgiven $20,000. That's nice savings, even if it costs you private costs and interest rates and fees to finance that loan before the end of the year 2023. So you can pay back the CIBC loan, the bank, whatever you borrowed, and you can be forgiven the $20,000. So right now, the stress isn't in the attention isn't so much on purchases. Like, if I had to count the number of purchases I have, I probably have like maybe, I don't know, half a dozen right now, and that's not a big number for the number of transactions that we do. All right, the number of refinances, which is really the volume of what everybody's freaking out about right now, like getting money before Christmas, planning the next year. Maybe some business people, for example, took a little bit too much money out of their business because they had to cover personal costs, and like now they kind of have to pay it back to the corporation if they don't want to pay income tax and all that money taken out, right? That's like a focus right now. Purchases right now is not a focus. There's too many other things that people are struggling with, which is like business debt, CRA debt, for whatever reasons they have it, weren't taking care of it earlier. Now they're really feeling the pinch. Consolidating like business loans. Business loans now are like above 10% on average. And those loans aren't amortized over 30 years. People who have business loans of $200,000, $300,000, like those guys are paying like $5,000 to $8,000 per month for $200,000 to $300,000 because it's amortized over 10 to 15 years. That's what's killing these people. That's what's killing businesses, because when interest rates were like, prime was 3% and you were paying like 6%, like, yeah, I could probably bear that on a 10 to 15 year amortization. But when it's at like 10%, like you amortizing 10% is hard, even on $200,000 to $300,000, it's just too expensive. So like that's a focus right now. That's a stress right now. People are freaking out about purchases and don't care about those so much. They're not caring about those so much, which is why there's so little activity, right, with purchases right now. But the next question is, what's going to happen after it? Well, once the year 2023 ends and we're through with all this CIBC loans, we're through with all this consolidation stuff, we have restructured and repurposed everybody's portfolios, and we're ready for 2024. Now is going to be the question of, well, whoever did it well, whoever finished the year 2023 strong, was able to reorganize their finances, perhaps reshuffle their debts, lower their carrying costs, improve their cash flow, create a little bit of working capital, whichever way that worked, they're going to be in a phenomenal position to do things in 2024, right? And so what's going to likely happen is, as we talked about this in the previous podcast, once there is a level of predictability that the consumer is comfortable with and they have resolved the issues of the 2023 year end, now the 2024 is here, and now we can look at things that we can probably invest in to do stuff with and work with. Because again, if you understand the idea and the concept of tension is the precursor of relief, and you understand that you're probably going to be buying these assets near the end of the rate hike cycle, or perhaps right at the end of the rate hike cycle, and you're likely to see some appreciation because the interest rates, once they improve, will stimulate more activity in real estate, well, then it makes sense to be ready for 2024. It makes sense to be able to make moves where in 2023 you may have been a little bit more afraid of it. Once there is a level of predictability and a level of expectation that is comforting for you as a consumer.
I like the way you kind of package that. And just to, I guess where my mind goes when I'm listening to you speak is, yes, consumer confidence for certain consumers is just evaporated and It's gone. for people who have money, they're not wanting to let this opportunity go to waste. I guess where my mind automatically goes to when you start talking about predictability is predictability for the entity it matters most for, which is the Bank of Canada. The Bank of Canada will only stop throwing that ball out of play for everybody once they feel they have a predictable hold over inflation, which is now sitting at right around what, 3.2?
Something like around 3%.
So getting inflation down has been the talk of 2023. I mean, that has been, if we could sum up that year, it was basically just a fight to get inflation under control. And do you think we're there?
I think, I just finished my Christmas postcards. So those of you who are part of my network, you will be getting them, including yourself.
Oh, thank you.
I made the Christmas postcards in ChatGPT. I used DALL-E. And my Christmas postcards depict a big inflation monster. A hairy but friendly inflation monster who, in my opinion, we're no longer fighting. We have sort of befriended him. We've gotten to a point where we can live with him, with this inflation monster. And it's ugly, and it's always kind of looking over all the stuff that we're doing here in Canada is sort of like playing his game, is being volatile, and then one day it goes up, one day it goes down. And so that's probably the best way I can describe the Bank of Canada relationship with inflation right now, because once we come to a portion of the battle where things are stagnant, which I think now, Bank of Canada has been fighting inflation, like literally with interest rate hikes and scaring everybody with all kinds of crazy, things that they said out loud and on the line. And now we've come to a point where we're no longer really fighting it. I think to the same degree, we have sort of befriended it. The monster isn't as scary. We understand it a little better. We've learned how to control it a little better. When I say we, I say Bank of Canada, and perhaps as a community. And now we're sort of okay with it, and we're moving along, and we're taming it as we go, right? And we're not necessarily fighting it aggressively. We're taming. We're making sure it doesn't get too out of hand, but it also it is doing its job. It's slowly subsiding. And I think as we progress into the year 2024 is going to be the point where we make him completely
a pussycat.
A pussycat. Yeah, we'll make him completely harmless. Right, and I think that if by the end of 2024 we can tame the inflation monster to being our friend and cooperating, I think we'll be fine. We'll be fine.
So, light at the end of the tunnel. Is the worst of it? Are we past the worst?
I really think we are. I really think we are. At least in terms of interest rate hikes, I think the Bank of Canada has seen the improvements that they were looking for. In fact, my opinion for the December rate announcement hasn't changed. There's going to be no change in the interest rate. I don't think so. It's going to be just hold still and wait. And for that reason, there is certainly light at the end of the tunnel. The tunnel, it's not clear how long the tunnel is, though, right? It could be that what Benjamin Tal mentioned in that report or in his conversation on that conference, that 2024 will grace us with some rate discounts. And there's maybe a possibility that it will happen, like you said, in the second part of the year. It's also not impossible that nothing will change at all. Like, it's also not impossible that the Bank of Canada will see inflation stay stubborn, right? And they'll have to continue holding rates just for the sake of seeing more improvement. They don't have a lot of tools. And because they don't have a lot of tools, they have to work with the tools that they have. And so 2024, I'm optimistic about 2024. I think the worst is in the past. But I think that there's going to be probably a good 6 to 12 months of very little meaningful improvement in the interest rate market. And when I say little meaningful improvement, like to those that are viewing this right now, what does that mean? All right, like to some people, meaningful improvement would be a 0.25% discount, because to them that's what makes their payments affordable, or unaffordable completely, because that makes them completely outside of their budget. But when I say meaningful improvement in interest rates, I think I'm referring to something that would make an impact on not just that one person who is struggling with an extra $100 on payments, but to sort of roll things back a little. Like that would be probably 1%, discount, right? Like if we've seen the prime rate go down to 6.2, which by virtue of how variable pricing typically works, like, it's not uncommon that people would have prime -1 on their variable rate mortgage. If prime is 6.2 and you're paying 5.2% on your interest rate on your mortgage, like, that's manageable. Like, some of the larger mortgages will be very expensive, but it would be meaningful. Like, it would make an impact. It would make an impact that will make those consumers feel that there is light at the end of the tunnel, and they should hold on to their properties and they shouldn't panic, because like everything else, rate hikes are temporary, and like everything else, they'll come to an end. Like everything else, there will be a summit on top of that hill, and things will be stabilized. And that is how I'm gonna probably end that answer.
There are a couple things that I think people should be kind of keeping an eye out for. And if we are past the worst of it, and if we are at the trough now, and it's hopefully uphill from here, which I do agree with you. I do think that we are there. It's not a nice place to be in right now, but it's definitely looking a bit brighter in the future ahead of us, as you said, as Benjamin Tal keeps saying, which I agree with. I think that the public yet isn't understanding the changes that are happening systematically with mortgages and real estate transactions itself. There have been a ton of changes that have happened in your industry, in how people are being pre-qualified, how they're being underwritten. And there has just been, I don't know if you're aware of this, a complete overhaul of my entire industry. I don't know if you're aware of this, but like
I've heard a little bit about it. Just tell me the surface.
It just happened. So it just came into effect December 1st. And they completely rewrote the entire REBA kind of legislation on exactly how people are going to be dealt with in the industry.
Thing that I was reading about, and I'm not sure this is entirely true, maybe you can confirm, there's also the type of representation has been changed. I think the consumer option?
You can self-represent. So you could self-represent before, by the way, but now they've made it much, much more clear about what that means.
Okay.
We used to have what's called a client representation and a customer representation. A customer was kind of like a self-represented person, but you still owed them some fiduciary obligations of some kind. And typically this would be like if, like a builder hired me and they wanted me, to facilitate transactions, but I'm not negotiating on their behalf.
They just want a real estate agent to do the paperwork and
facilitate.
Process it.
Yeah, facilitate. Now with self-represented individuals, you owe them zero. Obviously, you can't lie to anybody. That's granted, right? That's a given. But you don't owe them anything.
They're like truly self-represented.
They are truly self-represented. And now with these open auction systems and self-represented individuals, right, you're going to have a lot of ego playing into bidding up prices when they're not even understanding what is happening.
That sounds rough.
And it is going to create a complete disaster, in my opinion, for buyers. And if there are first-time buyers out there who were waiting for an opportunity, my advice anyways, for whatever it's worth, try to secure something before all of this becomes proliferated throughout the industry, because it will become normalized and it will become the norm. And once it is that frictionless and that easy to go ahead and just bid on something, when these open auctions are proliferated and they're online and it's a click.
If you're watching this right now, you're graduating from law school, I would highly recommend considering litigation. It seems like there's going to be a lot of files in the future.
There are.
Because when you self-represent, the number of times people will make mistakes, and this is why you should use service professionals for things that are worth a lot of money. You shouldn't self-represent yourself in these cases. I don't think it's smart. Unless you're in the industry, but then, like, who am I even talking to right now? You should really consider the client relationship with your realtor, because that will be the wealth of knowledge and experience that person will bring to the table will save you.
Look, it's the same reason why I don't fix my own car. If there are small problems and I need to get, let's say, something simple like an oil change done, like, could I look it up on YouTube and probably figure it out? Like, maybe, but do I want to risk damaging my car over that, and like the time that it would take and everything. And for somebody who knows all the tricks already, who's been through who's been dragged through the dirt on figuring it out and already knows what to avoid, I mean, yeah, like that's why I don't cut my own hair as well, right? So it's the same kind of idea. And I do think that the need for expertise in your industry, for people who actually know how to navigate through the minefield. I mean, I consider your industry a complete minefield, and mine's a pretty bad one. So I think that
it is a minefield,
right? And there's a lot of fraud, and there's a lot, and we're seeing that now.
A lot of mistakes, a lot of things promised, never delivered. I do see this all the time. And like, you know, when you are applying when you're placing an offer on a purchase, and if you haven't had a realtor who vetted you into that purchase by introducing you to a mortgage broker, introducing you to a lawyer, making sure all your professionals lined up, your inspector is ready to go, you know, your appraisal is ready to go. You're going to place that offer with no understanding of conditions. You're going to waive conditions that you don't understand probably, because you're going to be thinking like, why would I need that? My bank told me I qualify for $1 million, although they checked no documents. And then you're going to place these offers thinking that you know everything or that you checked everything through. But in reality, the process has been in place like this for dozens of years and hasn't changed much until now, perhaps, for a reason, right? Like, these are such significant financial decisions that if you're smart enough to pull it off on yourself, kudos to you. But 99% of people really need help. Like,
it's kind
really
of like
need help.
It's kind of like we've been bowling with bumpers on either side. You know, when you were a kid and like they'd like put the bumpers on so there are no gutter balls happening. It's kind of like we were leaning on professionals within the industry to be the bumpers, and now we basically remove the bumpers at the request of the consumer when they're not understanding what they're asking for. And I do think that we're going to see big problems.
Lawsuits. Oh, I can already see so many lawsuits. Oh my God. Oh, and there's going to be nobody to defend. There's nobody to counter lawsuit, because when you deal with a realtor or a mortgage broker and you take their expertise, they take the liability of representing you. That's why they get paid the big bucks. It's not because they are really good at, you know, drawing numbers on a piece of paper. It is because they take the liability of holding your hand until the end of the transaction, and removing that and leaving you walk through the valley of death with nobody guiding you is going to be very dangerous. The amount of lawsuits that will result from this, I can only imagine. And there's going to be nobody to blame but yourself if you chose that route and you use absolutely no help to get there.
These platforms are coming. So I'm really this is the first time I've actually
spoke about it
on YouTube or anywhere, because it's so new and because I didn't even really understand, and then I had some exposure to it through like I'm a part of like some really intense networks for real estate, and when I heard people talking about this, in particular Nathan Dart, and I was like, oh my gosh, this is like, what is coming is so insane. And if you go to Maryland, it's like very normal. It's very normal. But here we have a completely different market. There, you know, if you're in Maryland, for Christ's sake, compare that to Toronto in terms of real estate markets. It was like, imagine, you know, after 2008, you know, and it's not like the market was like it was like ours was, right? It's like, imagine you have like this baby calf who's just born and just getting up on its feet, and it's like doing pretty well, and it's like kind of just, you know, getting itself together, and then just gets taken out by a linebacker. You know, a linebacker just comes and just completely tackles it to the ground, and just like, it's done. You know, that's what happens there. What happens here is not that at all. In fact, over 2022 and 2023, when we had significant drops in sales volume, I mean, we're talking year over year 50%, right? Like it was bananas in the fall of 2022. And this fall has been no better, right? In fact, I think sales volume was down year over year, and month over month it was down from November to October. So we're talking about, for sure, a weak market here. Have you really seen prices move that much? I mean, compared to what they were, year over year, we're about even. Like, we haven't, in the last year, compared to last November, we haven't really dropped.
Well, no, it's not. We haven't seen the apocalypse. There's no apocalypse. I mean, if you believe that these things are going to go down to zero, you might as well just go and like jump off a cliff. Like nobody's expecting an apocalypse in real estate where things will just go down to whatever they were in 1984. Like I think that the little bit of volatility in prices that we've seen is what to expect, right? Unless all hell breaks loose and then I don't know, World War III starts and then things just go completely out the window. But I think if we have like decent levels of predictability in the socioeconomic realm, and we're not going to be seeing any craziness happening in 2024, then perhaps we'll be okay. But the thing that you're mentioning about the changes in real estate representation, the changes in the bidding system, right?
These are enormous changes. These are not little changes. The ripple effect from this will be a butterfly effect. It will be so massive. And, I'm putting it out there. I think that people are going to be really, really upset when this all...
the result?
Yeah. When this...
You might be right. Yeah, I think you actually probably are going to be right, because what we'll see is so many lawsuits and so many complaints filed against whatever that they weren't properly explained things, and then they will be told to read terms and conditions of their contract with the auction provider, that we will probably be talking about this again in December 2024.
But when you're self-represented, who are you going to sue?
Look, I can already guarantee you right now, the very first few lawsuits will be against the auction company. Because the consumer is going to say, oh, I didn't know, it didn't explain that, oh, this is like a final offer, I just clicked a button, right? And the judge is going to say, okay, Mr. Auction Platform, can you please show us what you've done to disclose the information to the consumer? And I mean, these are tech companies who's probably come from somewhere like in the States where they have hit their head on whatever enough times that they have included the terms and conditions clauses that remove any liability to them. And this is where consumers will find out that there is no way to sue, because the terms and conditions document was for them to read, and just because it's 25 pages doesn't mean that you don't have to. Right? Because a lot of the time it's just like, skip, like next, agree.
It's going to be like that South Park episode with the human centipede, right? And people are just going to be stuck to that iPad. And that's what's going to, I think that's what we're probably headed for. So I think it's going to be ugly. I think it's going to be something that people are really just not prepared for. But hey, that's just what I think. And I'd love to hear what you think. So if you could just comment below, let us know what you think. If you made it this far in the video, bless you. Thank you very much. And don't forget to subscribe to the channel and hit the like button so this can be pushed out to more people like yourself. If you're listening to this on Spotify or Apple Podcast, feel free to give us a review there so that we can kind of just help to proliferate this channel a little bit if you like it. And if you don't, well, I mean, hit the dislike button twice and that'll help. So... Konstantin, thanks for coming by, man. I really appreciate your time, as always.
Appreciate you having me here again. These are all very very important topics. I hope the audience gets enough value out of this to come back at the next episode.
Cool, man. And also, don't forget to follow Konstantin
at The Pocket Broker on Instagram, probably the best platform. Do follow and reach out if you guys have any questions with financing that is a little bit too difficult, or situations that are just not working in your favor. I'm as far as your phone. Just you can message me on Instagram, you can call me. All my details that you can use to contact me are available through my link tree, which is also on my Instagram.
Thanks, everybody.